This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. So I know many investors, not just value, but also growth investors, basically any stock investor out there is wondering, where can I even invest right now? Are the stocks that appear to be cheap to me even really that cheap? Because there's a lot of uncertainty going on about what's going to happen to earnings, what's going to happen to sales, what's going to happen to the tariffs, just what's going to happen. Nobody knows anything. And we're starting to see that a bit in the earnings reports that are coming out now, in the guidance. If a company's guiding at all, they're doing what United Airlines did, and they are guiding one scenario if the recession doesn't happen, and another scenario if the recession does. But most won't get that crazy. They'll just say, we have no visibility, we're withdrawing any guidance, and we'll take it quarter by quarter, because they do have experience doing this after doing it during the pandemic as well. And the market is accepting of that, as they did during the pandemic. So there's nothing lost by them withdrawing and kind of just taking it quarter by quarter. But that leaves the rest of us investors kind of up in the air about what does this scenario look like? And why does that matter when we're buying stocks? Because we are buying those earnings. We're buying the sales and the earnings as owners of these companies. And I don't want to overpay if those earnings are going to decline. So things that look cheap now or are cheaper than, 2 or 3 months ago, maybe aren't not that cheap right now. So I wanted to take a look at 5 companies today that I know a few that have really sold off big that might look cheap. Some that we've talked about in the past on other podcasts. Some we never have because they've been too expensive and we haven't been able to even consider a few of these, but they're mostly companies that are going to be impacted by tariffs and or the recession. Obviously, all companies impacted by recessions, but they're consumer oriented. They're in travel, apparel. Actually got 3 travels, 1 apparel, and then 1 that's in staffing that we've talked about that definitely, if we have a bigger recession, is going to be impacted even more than what it's already seeing. So let's just dive right in and talk about a few of these companies and take a look to kind of see what's happening right now before earnings, and if we can get a handle on whether or not any of these are actually cheap. So I'm going to open it with a hotel company because these have really seen a big rally after the pandemic. We might have talked about some of these at the heart of the pandemic. We definitely talked about some of the REITs, which own the actual buildings, but I wanted to talk about the brands, the Hiltons and the Marriotts and the Hyatts of the world, those big brands, because they did get hammered initially, obviously, in the pandemic when there was a global halt to travel. Then everybody wanted to stay in Airbnbs or Verbos, because we didn't want to be near anybody in an elevator in a hotel. We just wanted to escape to our house in the countryside that we rented. But then that went out, and now we've returned back to the hotels. These companies have all been expanding globally and quite aggressively, actually, those big 3, I like to call them. And I chose to talk about Hilton today, ticker H as in Harry, L as in Larry, T as in Tom, HLT, because I am a Hilton member. I'll just put that out there. I've stayed at all of these. Of course, most of us have. But Hilton, I've been staying at more during the pandemic and travels with the kids on all their travel programs for sports. So it's one I'm a little more familiar with, and it has been very expensive stocks, trading over 30 times on the forward PE. But now just taking a look at it right here, I see that the stock has come off. Obviously, all these travel stocks have. And over the last month, it's actually down 10.7%. So that's making the PE a little bit cheaper here. It's come down off of over 30 times. Now it's at 26.7. Is that really cheap? Not really, but it is cheaper. So I like that, but it's unclear if that E side is going to hold with this. Now, we're really not going to see it in the first quarter. All of those trips were mostly booked. We might see some pullback in government travel, like the airlines say they're seeing. They are going to stay in the hotels when they're traveling around the world for business. And even just like the government contractors, that kind of thing, we might see a pullback in the first quarter, but it's really not going to hurt the regular consumer like you and I until much further down the line, because we have already booked our spring trip. Maybe you've already gone on it. This is the Easter week right now. I know a lot of kids have already had off school. People have already done that spring trip. That was booked 6 or 9 months ago. So even if you're a little jittery about what's going on in the economy, or even if maybe you already lost your job, you still are probably going on that. And same for the summer. A lot of the summer travel already booked well ahead of time. So they might not see it for a little while yet, but I'll be interested to hear what Hilton and the others like Marriott and Hyatt, Best Western, Wyndham, there's others, what they are all saying this earnings season that they're seeing in the bookings, and if they're seeing any slowdown there in demand. They report on April 29th. So that is coming up quickly. I'm recording this on April 16th. So we're going to find out soon what is actually happening with Hilton. But that forward PE is not that cheap yet, even though the stock has come back. But what do the earnings estimates look like? So they're expected to see, up until now, 11% earnings growth for 2025. And we have seen some estimate changes, some revisions. Even in the last 7 days, one analyst has cut. Nobody's raised, one cut there. So we're looking for 791 now, and that hasn't changed in 7 days. So the one cut is not enough to bring it down, but it is down only a couple cents in the last 30 days. So the analysts aren't getting too crazy, it looks like, right here. They're not too nervous yet. But it is bearish to have the analysts cutting within, a week or 2 weeks before the earnings come out, unless someone is pre-announced, of course. But it is still bearish for them to go out on a limb and say, you know what, ahead of this earnings, I think I'm too high, I'm going to cut here, and then to do it, because they usually just will wait until the number comes out and then they'll adjust, especially with all this uncertainty. So it is, even as I said, more bearish that they are willing to cut into this number. So we'll see what happens with Hilton. But again, we don't know if this 11% is going to hold here, or if we're going to see further cuts once this earnings report comes out. This is the mystery. But this one is not that cheap. Hilton, 26 times. None of the hotel chains are cheap, as I mentioned. I would like to get into one if I could. Marriott's a little bit cheaper, 21.9 times. It's also considerably off of those, their recent highs. Let me see what the 3-month is on Hilton. Hilton 3 months down 15%. That's not, that is pretty significant because they've been booming up until now, but it's not 30% or something like that. It's not even a bear at this point, not quite yet. So Marriott over the 3 month, the chart did look worse than Hilton. And it's down 21.2%. So that is now in an official bear over the 3 month. And year to date, everybody is down. Hilton, again, similar to the 3 month, down 15.3, Marriott down 20.9. So I'm keeping an eye on these stocks because I do like these companies. They are expanding quickly into large parts of the world where they weren't. The loyalty programs are working. I know they work on me. I think they work on everyone, no matter if it's hotels or what it is. You will look for that hotel in the market that you're going to try to get those points so you can get some free nights, even though, is it just me, or do you need like an extraordinary number of free nights now, or else you really don't get anything? You get like one free day after you spent like 40 days or something like the hotels. But maybe I just like to stay at the more upscale places with my free points. I don't know. But I've even looked at the cheaper places that you wouldn't normally use the free points at, and it still takes a lot to get that. So for now, these loyalty programs are working, but maybe not for forever. But still, I'm keeping an eye on these hotel stocks. I'm leaving the REITs for a different episode because they actually own the buildings. But Hilton Worldwide, HLT, not that cheap. And we're waiting on those earnings. Okay, then another travel stock I wanted to talk about, which I don't think we ever have, is Booking Holdings, the online travel agency, as they're known. So I own Expedia in the value investor portfolio. That's ticker EXPE. That's a competitor to Booking, which is ticker B as in boy, K, N as in Nancy, G, BKNG. Now, what differentiates them? Booking really, remember, was Priceline. Booking owns half of Ctrip, which is the big online travel agency in China. That's why I like Booking. Booking is more international and it's huge in Europe. Tons of European travelers use Booking, and they have a better hotel and like even short-term rental type of selection in Europe. They're also in the US, but big in Europe, which is why I like them. So Booking, let's take a look at what's going on there. Similar, not surprising, the stock is down year to date, just 8.4% on Booking. But over the last month, it's actually up 0.9. Wow. I own Booking in my own personal portfolio. I haven't been watching it super closely because I was just assuming it was down big, but it's not so bad. Now, the good thing is they don't actually own any of these hotels or anything like that. But the bad thing is, obviously, if travel contracts, it is going to impact them. And we saw this in the pandemic. They had to lay off a significant number of people right when the pandemic hit. But now that everything is reopened, things are back and looking better. We have 2025 earnings expected to be up 10.6. This is before anything else happens. But one estimate has been changed, but revised higher in the last 7 days. Wow. Nobody lower for this year. For 2026, one higher, but also one lower. So it's a little more mixed for next year, but still plenty higher and lower in the last 60 days, 7 higher, 7 lower for this year. And so that was after the last earnings, most likely. And they have a good earnings surprise track record. They beat 4 quarters in a row. Last earnings quarter was a big beat, 16% earnings beat for last quarter. So we'll see. But I think most people assume that this is going to change and change quite a bit, perhaps. Now, what about valuation? It's trading with a PE of 22.3. That's not as expensive as Hilton. It's not as cheap as Expedia either. Expedia is always traded at a discount to Booking. People prefer to get the industry leader and they're willing to pay a little bit more for it. But Expedia, a lot cheaper on a PE basis. And I want to say it definitely has pulled back more than what Booking has. Now, maybe the high price of Booking is impacting because it's trading, at like 4,000 a share or whatnot, way up there. They have not split the stock. And it just means less trading volume. It means the bigger guys are in it, the hedge funds or mutual funds, the professional money managers are in it much more than those of us, that might not have that much money to buy even one share. So maybe that's helping it a little bit during this time of volatility, of not being quite as volatile. So Expedia trading at just 10 times here. And those earnings expected to be up 21.4% this year, with one estimate also raised on Expedia. So I'm going to put that on the list as being a value here. That's why it's in my value investor portfolio. It always has been cheaper on a PE basis, but looking pretty good with a PEG of just 0.5. And this stock has also pulled back, as you might imagine, because of everything going on. Nobody wants to own anything consumer related. And Expedia, now over the last month, it's down 8.1. Year to date, it is down 18.5. And we are feeling it in my value investor portfolio for sure, nearing that bear level. But that's why it's gotten cheaper than ever. We'll wait and see what they report, as that earnings report is also coming up soon on May 8th for Expedia. And booking, I forget when they are. Let's see, the same day as Hilton, April 29th. So April 29th turning out to be a big day for the travel stocks, because we're going to get two of the big names to let us know what they're seeing there. But that's booking. BKNG, it's not super expensive, but its stock is holding up. So it hasn't gotten to the cheap level yet. And Expedia has been cheap because it's really pulled back. But can these earnings hold? Will this be a trap? Expedia, EXPE is the ticker there. Okay, switching to the staffing. This one is AMN Healthcare. We have talked about it many times on the podcast over the years, because it's always shown up during the pandemic, at least in our screens. It always had remained fairly cheap, so that's why it was a value. And then those earnings soared because AMN Healthcare Services does medical staffing. It has their app now. If you are a travel nurse, you can sign up on the app, find out who's looking for someone, accept an assignment right on the app, and you're off and running. And those wages really soared during the pandemic. Everybody was in need of the travel nurses, even doctors, everything on the healthcare side. But that has fallen way back. And as I think I've mentioned when I've covered this stock in the past, we used to own it in the value investor. We had to sell it because every quarter it was for, at least a year and a half now, maybe longer. It's been, we see the light at the end of the tunnel. It's coming in a quarter or two. The wages aren't going to keep going down. Demand isn't going to keep going down. It's going to turn. And then it never has. Still has not. So this is a Zacks number 5 strong sell because of what's happening with those earnings. The earnings have continued to get cut. I can't even believe it. They continue to be, because when I was in it, they were being cut, and that was a while ago. And so now we're looking for 99 cents for 2025. They made $3.31 in 2024. And I want to say it was, $10, $11 or something during the pandemic years, or maybe even higher. And now we're back all the way down to 99 cents. This is a decline of 70% for this year. 2026, they're thinking, okay, that's the worst, and it's going to rebound to $1.47, up 49%. But I've seen this play before, and it has not rebounded, even though the analysts all believe, okay, it can't get any worse. So AMN, I'm sticking away from it because it's not that cheap on a PE basis. It's trading at 19 times, but the stock is now at new 5-year lows. So year to date, it's down another 25.9%. But it's down over the 5-year period, even below the pandemic levels when it initially sold off. 5 years, it's down 67% now. That's pretty grim for all long-term shareholders, and I'm sorry if you've been in it all this time. This is a good example of, yes, it's a good business. Management is fine, but the market conditions are just terrible right now. And so you should be out of it. There's no dividend. And so you're not getting anything for your patients, and just you're going to have to wait for even further bottom. And nobody can time the bottom perfectly. We won't know until they finally say, we see an increase in earnings for next quarter or next year. When they finally say that, the stock will already be pricing it in. It will be off the lows. But we haven't heard them say that. So we're waiting on AMN, but this is one we have talked about many times on the podcast. Earnings are on May 8th. So a couple weeks, we're going to find out if the turn is going to be here, but the market is thrown in the towel. You know, we've got the lows and it continues to fall here in April. So it hasn't actually bottomed. 1 month, it's down 28% in the last month. 5-day return, it's down 10% over the last 5 days. And I'm recording this on April 16th. So on the day that the reciprocal tariffs went into effect, and now a week later, it's down 10. And they're not even tariff oriented. And this is how bad it is. But this is a good example of, you know, basically everyone just getting out at this point. So that's AMN Healthcare, ticker A as in Adam, M as in Mary, N as in Nancy, AMN. Then let's take a look at the Gap. I've talked about it many times. It's actually a Zacks #1 rank, but they have operations worldwide. They have manufacturing, from what I understand, also globally. So they have exposure to both tariff side and recession side in the US and elsewhere. But they have a lot of cash. They pay that big dividend, yielding 3.5%. They are a #1 rank with an A across the board for style scores. And they're super cheap at PE of 7.9. That's it, 7.9. But there's all this risk out there. So the stock is weak here, not as bad as AMN Healthcare. Taking a look, why does it have the #1 rank? Because one estimate is being raised. In the last week, someone's decided to raise here, and it's gone up to 237 from 215 just 60 days ago. So that's not too bad. And that is earnings growth of 7.7% if it holds. But this is going to reflect the prior quarter, remember, before more craziness has happened and before any higher prices have really been passed through due to the tariffs. But people kind of getting out of any of these apparel names. Gap is down, as I mentioned, 8.6% over the last month. For year to date, it's in a bear market, down 22.7%. So it has been hit, but it's gotten cheaper. But this had been one that was rallying, but now it's giving back a lot of that rally over the last year because Gap has turned it around in some of its brands again. And it is seeing positive comps, as we've talked about on this podcast, but that might not hold. A lot of uncertainty, as I keep saying. I know I sound like a broken record, right? Might not hold. We don't know. Have to wait. But this is true of everything. We're about to get some more answers. It doesn't report until the end of May. So we're going to have to wait. But on some of the other apparels and like shoes, other things that are going to be impacted in a similar way to the Gap, we're going to get some of those a little bit earlier. So tune into those. I'm thinking of like Deckers and Skechers on the shoe side. They report early. So we're going to have at least some color on what the consumer is doing on like similar items, similar price points to Gap. So keep an eye on some of those. But that's Gap, GAP. They're back to the old ticker now. So we'll keep it on our watch list, even as a Zacks #1 rank. Okay, and then we're going to wrap it up with another travel stock, the cruise liners. They've all been cheap for a while. Then they soared last year because they were having record quarters. I can't even believe how many of you are booking your cruises. And with the stock market last year at all-time highs, people felt that they could easily do this. Why not? My portfolio was surging. I could splurge on that $10,000 cruise I've always wanted to do to the Mediterranean. I want to go to Greece. I want to see some ruins. And so I was booking it on any of the cruise lines. It didn't matter if it was luxury. It didn't matter if it was the lower cost ones. Everybody was crushing it. And they still kind of are. Carnival was the latest cruise liner to report. I want to cover Royal Caribbean. They are also reporting, I'm seeing here, on April 29th. That's the D-Day for the travel stocks. Booking, Royal Caribbean, Hilton, all on April 29th. I'm gonna be going out of my mind trying to listen to all these conference calls at the same time, but Royal Caribbean before the open, so that might help me. I might not have to be on dual ones as much as I think on that day, but Royal Caribbean, still really cheap stock here on a PE basis at 13 times. I used to own this in Zacks Insider Trader, but we did sell with a big gain. In 2024, I believe, is when we got out. PE, as I said, 13. PEG ratio of just 0.6, because what's happening with this one, it is just a number 3, which is the hold. So one estimate is being cut in the last 7 days. So someone is getting a little more bearish on the cruises, which I'm surprised, because Carnival in its last earnings report just a couple of weeks ago said the consumer is fine. They're not seeing any. The bookings have already been made for 2025, but even for 2026 now, bookings still strong, and the onboard spend was still strong. Even if you booked the cruise a year or even 2 years ago, in some cases, you're still going on it because you've already paid. And you may cut back on certain things on board. Like, you're not going to go to that steak restaurant that costs extra. You're not going to upgrade your wine because that costs extra, and you're worried about your money now. But that's not happening. They're not saying that, not yet. So all of this could come, or maybe it doesn't. This is the United Airlines quandary. They gave the earnings with, avoiding a recession and with a recession and a slowdown. So what do the earnings look like? $14.83. It is down a little bit in that 7 days with that one estimate cut from $14.86. So down 3 cents. They were expected to make $14.89 60 days ago. So not too much finesse here, just 6 cents lower. Nobody's raised, but we do have that one cut now. So we'll see 25.7% earnings growth expected in 2025 and another 15% in 2026. But as we saw with the pandemic, the travel stocks can change on a dime. You don't have to take that trip unless you already paid for it. But if you didn't, you don't have to go on it. You can either not book it or cancel. And so that's another thing to watch. Any kind of cancellation, if they have an option to do so, are they starting to do that more? That'll be a sign of stress in the consumer as well. What does this shares look like? So year to date, they're down 16.9. That's why I've got still the cheap stock, because those earnings remain elevated, but the shares have pulled back. And over the last month, Royal Caribbean down 12%. In that period. So AMN Healthcare, the worst performer in the 1 month period, and booking now up 1.3% in that 1 month period. So everybody's thinking, hey, the Europeans might not feel this as bad. And there are a lot of European customers at booking, and maybe they'll be taking the vacation still over in Europe. They won't come to America, but they will book European hotels. And on a side note with the airlines, United Airlines said that it is seeing some weakening in domestic flights, but so far international has been holding up well. But these would be like US travelers going over to Europe, and not so much the vice versa. But a little bit of that. You might still get some people flying United out of London instead of British Airways over to Chicago, for instance, but not quite as much as the other way. So this is going to be an interesting area to watch. I'm going to be watching all these stocks as we go along here during earnings season, and on April 29th, maybe I'll do an update once we know more. But are these values? A lot of these are values on a PE basis. Almost all of them, other than Booking at 22 times, Hilton at 26.7 times. Everybody else has the less than 15 PE. AMN did not. They're at 19 times, but the shares are now getting killed along with the earnings. So they're a trap, obviously. But some of these, they are values, but the trap is still there. I'm sorry to say it's probably going to be there for another couple of weeks until some kind of resolution to the trade war. And we just see what happens with the U.S. economy here as we move along. But I'm still liking this sector. Don't count out the U.S. consumer or even the global consumer. And you might be able to pick up a deal if you're a little bit patient here and as we go along. So let me repeat the stocks. We had Hilton Worldwide, HLT. We had Booking, BKNG. We had Expedia. I'm throwing that in there. EXPE, a little bonus stock. We had AMN Healthcare, ticker A, M as in Mary, N as in Nancy, AMN. We had The Gap, trying to resurrect itself, GAP. And then we had one of the cruise lines, Royal Caribbean. I like it a lot. Ticker RCL is the ticker with that one. R as in Robert, C as in Charles, L as in Larry. And as always, I'm trying to find you value stocks. There's plenty out there, but we don't know if they're real values or traps right now. A lot of us are still on the sidelines. We're making our short lists or our watch lists. This was a good watch list. I own Booking in my own personal account, as I've mentioned, but I haven't added to any position here because it hasn't really sold off that much for me to be like, wow, what a deal. But I'm always keeping my eye on doing so on any of these. And we still own Expedia in the value investor, but it has taken quite a tumble here, and we'll see going into this earnings report what happens. But a lot going on, so make sure you subscribe. Get us on Apple, we're on Spotify, we're on Amazon Music, we're on SoundCloud under Zacks Market Edge over there. We're on just about every podcast platform. We're also on YouTube on our own podcast channel. Get it on Zacks Podcast, or just put in Zacks Value Investor Podcast and you will find it and subscribe there. I know many of you are. You can get all of our, most of our other podcasts there, including ETF, Spotlight, and John Blank's great market analysis and updates there, his global takes every month. So be sure to get us somewhere, and I'll see you again next week on the Value Investor Podcast.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.